Hello everyone. I see that the number of participants is stabilizing. So let me introduce myself. I'm Christian Gollier, and I will share this first session of the CEPR virtual conference on climate change and sustainable finance. So a few words about the organization. So this event is co-organized by two CEPR RPN, so the one on climate change that I share, and the one on sustainable finance that is shared by Dirk Schoenmaker. And it's also co-organized with CEPR partners and members. Okay, so we will have three sessions. One this afternoon from now to 5:30. I'm switching to London time. And two sessions will be organized and shared tomorrow by Dirk. One on decarbonizing supply chain that will start at 2 p.m., again, London time. And another one, that session on climate stress testing and modeling that will start at 4 p.m., again, London time. Okay, so the session today is about financial risk and opportunities stemming from climate change. And we will have two papers, presentation for 25 minutes each. The first paper will be given by Stephanie Kelly and Jeremy Lawson from Aberdeen Research Institute on climate scenario analysis. And another paper will be presented by Sébastien Pouget from the Toulouse School of Economics on shareholder engagement on climate change issue, a theory and some facts. So without further details, let me give the floor to, I think, Jeremy Lawson, that will start the presentation of the first paper. Before doing that, just one word. Please don't hesitate to put your question on the Q&A part of the screen. You see there below the screen, you will see your access to the Q&A. And I will use that to launch the discussion that will start at 5 p.m. Okay, so Jeremy, the floor is yours.
So thanks everybody for joining us today. I'm just going to give a brief introduction, then I'm going to hand over to Stephanie, and then we'll sort of come back to me. But so I was thinking about a useful way to motivate our presentation, which is really about how can we embed analyses of climate risk and climate opportunity in a way that is useful from an investment perspective. Because so we're a research institute, but we sit within an asset management firm, and so that is front and center of our minds. It's less about stress testing and more about how can we build frameworks that allow us to mainstream this type of work. So now you can probably tell from my accent that I'm Australian. If not, I'm advertising it now. So I started working on climate policy issues all the way back in 2006 when I started to work for the then opposition leader Kevin Rudd as a climate policy advisor in the run-up to the 2007 federal election. Since then, Australia has had more turns in its climate policy than in a typical Formula One track. It has been anything but linear. And this matters quite a lot in the context of scenario work, because often when you're considering doing climate scenarios and then trying to use that to analyze portfolio risks and opportunities and how you want to invest around it, you're often sort of forced into what I'm going to call two extreme stylized options. One set of scenarios effectively assumes that the world never gets its act together when it comes to climate policy. And so you're in the realm of hothouse type scenarios in the NGFS parlance. The other is that actually climate commitments globally are entirely and almost fully credible. And so you're into a variety of scenarios ranging from 1.5 degrees to different iterations of below 2 degrees. But where in these off-the-shelf scenarios that are available to analysts, there is very little in between those two extremes. Now, this matters quite a lot because what we're going to argue is that the messy reality of global climate policy is that there are really significant, likely, not just today, but future divergences in the way that climate policy is managed across sectors and managed across geographies. And if you have no way of taking that into account in the development of the scenario analytical framework, right, and thinking in a forward-looking way about what's probable across sort of different geographies, then it's very hard to then sort of pin down the type of insights that you need to build into investment integration. So that's my motivation for that. It's about sort of taking into account the messy reality of the political economy of climate policy in a rigorous, sophisticated way so that we can make better investment decisions ultimately around the energy transition. So with that, I'm going to hand over to Stephanie.
Great, thanks, Jeremy. And just to echo Jeremy's points, it's really great to get to discuss this work. So Jeremy's going to get into the meat of the climate scenario research that he led on, and specifically around the applications as well. What I wanted to do for this part was just talk you through the nuances that we've tried to apply when we think about climate policy. And specifically, we did a significant piece of research a few years back called Going Green. And the idea behind that was that, particularly in the finance industry, there's a tendency to just take for granted, that climate policy is, as Jeremy kind of mentioned, even across all areas. But the other element of it was that even where you account for differentiation, there's a tendency to just take political leaders at their word. And for those who were watching closely, I'm sure, the COP26 meetings, it was a really interesting opportunity to assess what politicians are saying they want to do. But of course, we know in reality, those of us who look closely at climate policy, we know that that in reality can look quite different once it goes through the sort of sausage maker that is domestic politics and political economies. So with that in mind, what we did was built out a way of categorizing and scoring countries on the basis of their climate policies. Now, we focus very much on developed markets. This probably doesn't apply as evenly for emerging markets, but particularly we had a focus on the big major markets, the US, Europe, the UK, Australia, Canada, Japan. And so you can see here on the first slide, the structure of the index. So the idea we had was to build an index which would have some kind of data element telling you where we are today. So the levels of emissions and reliability on renewable energies and energy efficiency. That was an important component. And you can see our first two pillars of the index are around decarbonization. So measuring in particular GHG emissions intensity today and the trend, and also then the low carbon energy element. So again, measuring the share of renewables in both the current levels and the trend. So that's the change over the past 5 years, and also looking at levels of energy use. And the idea behind that is to capture where are countries today in their climate journey. But of course, when we want to look forward, and particularly for the kind of scenario analysis that Jeremy is going to talk about, it's not just about where we are, it's very much about where we think things are going. And although it can be very difficult to predict the path of climate policy, it is nonetheless an important one for us to try to get to grips with. And so to the two pillars of the index, decarbonization and low carbon energy, we added climate policy itself, and that gets a 50% weighting in this index. And the idea there is to try and start to bring together a coherent assessment of how countries are set up politically and in terms of their institutions to tackle climate policy. And I'll talk through the structure a little bit more. If we could go to the next slide, Jeremy. Thank you. So this just gives you a little bit more detail around the precise sourcing of the data that we chose to use and the weightings that we applied. You'll notice a few things straight up front. So firstly, we put greater weight on the level than the change. And that just reflects a couple of different iterations of the index in which we assessed what different weightings would apply. And in particular, that weighting seems to be a better representation of the kind of current levels, allowing for the fact that some countries really have been on quite a profound change. And then crucially, this policy assessment, which I'm going to go into. Now, in many ways, those who are closely tracking climate policy may be aware that there is a climate change policy index that the IIGCC recommends. We tried to use a similar structure to that index in our own approach, but with a crucial difference of the weightings being slightly different. The data on GHG emissions and renewable energy use have about a 50% weighting in the index, and our own in-house forward-looking climate policy assessment has another 50%. And that was really important to us, both the weighting and the fact that we can put this in-depth climate policy assessment into this index to allow us to really understand the nuances and differences across countries. So if we go to the next slide, please. What we can see now is the beginning of the climate policy assessment. I wanted to start here because this is really where the index is differentiated. So what we did was we identified 8 elements to kind of track in this climate policy space. So firstly, we looked at party politics and ideology. I think you only need to look to the United States to see why that's an important factor to bear in mind. As much as you might have a President Biden who is very keen to act on climate change, the realities of Senate and House politics in the United States, of the two-party system, and indeed of the differences even within the Democratic Party around how you tackle climate change has a clear impact on the actual outlook for US climate policy, whatever the hopes of the president might be. We also utilize institutional stability and transparency, which comes from our global ESG index that we created, comes from the political section of that index. And on top of that, we look at policy coordination. How well is policy coordinated and distributed within a system? So this is really getting into the institutions, the political economy of a system. And then looked at private actors in political space. We know the role of lobbying power can be very powerful, both for negative and for positive. And as you can see, in each case, we score between 1 and 5, trying to align whereby 1 is generally the worst possible score and 5 is the best. And in most cases, most countries aren't a 1 or a 5 across the board. We tend to have a lot of 3s and 4s, but nonetheless, we still get a lot of differentiation. If we go to the next slide, we can talk about the other 4 categories. And this is really where we get into the policy action. So not just taking, an NDC as face value, but actually saying, okay, but what's in place or what's coming into place? And so we have here carbon pricing, obviously a crucial factor. And there we also assign levels of carbon prices that we think are important. This is very much aligned to the work that Jeremy is doing on scenarios that I'm sure he'll talk through. In addition to the carbon pricing, we also looked at binding commitments, because any politician can make a commitment, but whether it's legally binding at the national level or in the case of the EU, at the supranational level, and the extent to which it causes any harm or discomfort for politicians, we think is an important component to draw in as well. And then we looked specifically at climate policy, and this is around how connected is climate policy, both to other policy actions, other policy decisions, and to business engagement. How well linked in are those? Because we know that the requirements of the energy transition are such that really you want the public and private sector rowing together, not rowing apart. And finally, we looked at household and business incentives. And again, this is trying to understand what incentives are there in place for the consumer and for businesses to shift their behavior. So that could be things like incentives for EV purchases for households, incentives for green energy for housing, things like solar panels, changing off of gas networks, and also looking at business incentives, so tax breaks, tax credits, things like that. If you go to the next slide, we can look at the output. So here you can see the countries we cover at the moment. We cover most of the major markets. And what you can see is first off, that no country gets 50. So they can get a maximum score of 50. No country gets 50. This shouldn't come as a huge surprise. This is reflective of the fact that policy just currently is not aligned to net zero for most countries, if indeed actually all of the countries in our metric. But also what you can see is quite a significant amount of variation in different countries. So you can see at the bottom of our index the US, Australia, and Japan, and at the top we've got, unsurprisingly, countries like Sweden, Denmark, and to a degree Spain. And the Europeans, they kind of are neck and neck, and that's partly reflective of the EU infrastructure that's in place around green policy. Now, if we go to the next slide, I'll just finish off by showing you how that all comes together. So we take those scores for the climate policy index and we add them into emissions intensity, renewable shares, and energy use. And again, we have that 50-50 split between the data side and the policy assessment side. And again, what you see is no country is perfectly aligned. No country gets 100. That's the highest possible score. And that tells us that, again, no countries are currently aligned to net zero, which I think is a reality that, while understood in the climate policy space, is not well understood often in the finance space. But again, you see similar countries come through at the top of the index. So again, Sweden, Denmark, the UK comes out very well because of the progress that's been made around renewables use, so that it kind of bumps its performance up relative to just the policy score alone. And similarly, the US and Australia are at the bottom of the index again. And part of this should make sense, because in a way, countries that are further along in their climate policy are probably reflected in their data. But as you can see with the UK, it's not a perfect match. And I think the nuance is really in looking at individual countries where they have space to improve and where they're doing quite well. And I think that's been one of the values for us, is being able to identify which regions and which countries are better fit for addressing climate policy going forward. And this structure allows us to go back to this assessment every year and reassess and reevaluate. And especially after COP in January, we'll reevaluate this index and potentially come out with slightly different scores. Again, we'll be more focused on the action, not necessarily just the rhetoric at COP, but I think it's a useful structure for us to use. So Jeremy, I'll pass back to you for you to talk through the scenario analysis.
Perfect. Thank you, Stephanie. So what Stephanie's talked through, which is how do we build a credible forward-looking view around the likely path of climate policy, is going to play a really important role in the way that we've built out our climate scenario framework. So I'm going to try and do a bit of a whistle-stop tour here, given the time constraints. But this slide just represents the 4 key building blocks of a scenario analysis project. So the first is obviously building the scenarios themselves, particularly the transition and sort of physical pathways that underpin them, whether they be, as I discussed earlier, hothouse world, early action, sort of 1.5 degree alignment, these sorts of things. Then those pathways are then translated into a series of economic shocks through integrated assessment models, energy systems models. So, for example, a particular emissions pathway would be associated with an implicit sort of pathway or an internally consistent sort of carbon price trajectory, and that carbon price trajectory represents an economic shock in the system. Then we combine this with very detailed analysis at the corporate level, so individual securities, so that we can understand how these economic shocks influence the income streams of different securities. Here I'm going to focus on listed equities in the MSCI Global Equity Index, and then also listed corporate credit securities. And then, of course, then we sort of finalize by generating fair valuation estimates that sort of just use fairly standard capital asset pricing model assumptions. So the core of our work can be summarized in this particular slide. So I can see that there are a lot of different colored dots here, or sort of squares. So I'm going to try and point out what I think are the really important takeaways. At the beginning, what I tried to argue is that in standard climate scenario analysis, the messy sort of reality of divergences in policy pathways across sectors and geographies are generally not taken into account. And so this is represented in the scenarios below the black line, so scenarios 8 onwards. Right? These are what we describe as off-the-shelf scenarios, and you can see that every sector geography combination receives the same color, because that's what's implicit in these types of scenarios. There are a couple of differences within a couple of the NGFS scenarios, but for these NGF scenarios, generally you're assuming that within this particular scenario, all sectors and geography sort of policies are aligned along an identical pathway between now and 2050. But as Stephanie's argued, and I would argue, it's extremely unlikely that we're ever going to get into a situation where global policy is aligned in that particular way. So what we have done, incorporating sort of partly the work that Steph described, but also having to extend this to encompass sort of China and the rest of the developing world, is bespoke scenarios which allow us to make different choices for how we think that the most probable pathway of policy is going to align in these major sort of geographic regions and sector combinations. So as a rule, green boxes are going to represent larger, earlier action, and then red boxes, pink boxes, they're going to represent sort of weaker policy and hothouse type scenarios. But so the main takeaway here is that we think it is more likely that the European Union will converge on, say, a net zero or a low emission pathway than we think is true for either the United States or the average across the rest of the developed economies. That they, in combination, are more likely to complete a net zero transition by 2050 than China or the rest of the developing world, and that China is moving a little bit more quickly than the rest of the developing world. So that's from a geographic perspective. From a sector perspective, we can also see how often policy is more stringently applied to the power sector, increasingly to the transportation sector as well, if not quite as stringent, with the buildings and the industry sector lagging behind that. And so again, this sort of gives us a lot of sort of possibilities for allowing for this type of policy divergence. We also allow for different technology pathways because different integrated assessment models make different assumptions about how the relative price of different sort of zero carbon technologies are likely to evolve over the next 30 years. And we think it's important to take that into account. So what we then do in part, sort of again, drawing on that work that Stephanie described, is we then assign indicative probabilities to each of these scenarios, higher weights to our bespoke scenarios because we think that they're more plausible, but we're not anchoring on just one scenario here. We're recognizing that the future is difficult to forecast, right? But if we can span this probability distribution in a more appropriate way, we can get a better sense of what the future might look like, particularly compared to what we think is priced into assets today, which is the baseline scenario in the top line, where there is some progression in climate policy, but we certainly don't think that the energy transition that we're anticipating is fully priced into assets. So I'm going to provide a couple of examples of how this matters. So this is all of the scenarios sort of lined up from the least amount of abatement to the most amount of abatement between now and 2050. What I want you to do, though, is focus on the turquoise line right in the center. Right, so that is the mean scenario, right? So that takes all of those individual scenarios, applies the probability weight, and then it generates an emission sort of pathway as a result. You can see how that lies in the middle of these sort of scenarios with later, more delayed, weaker action, and then what you might describe as different variants of Paris-aligned scenarios. But this is quite deliberate, right? If we didn't have this mean scenario, this big portion of the probability mass we would think was actually unexplored properly within the work. And we think it's really important to do so, particularly if we're trying to understand how asset prices are likely to evolve in the future or what the fair value is today, rather than just think about it through the spectrum of stress testing and tail risk. That generates a very similar sort of implicit pathway for temperatures, right? So clearly sort of Paris-aligned sort of pathways are going to generate sort of temperatures by the end of the century that are either sort of very close to 1.5 degrees or a little bit above 1.5 degrees. Hothouse scenarios are much higher again, but a lot of our bespoke scenarios, they sort of generate in this range of about, 2.3 to 2.6, 2.7 degrees. Again, it's a type of temperature range that isn't sort of often properly accounted for in this exercise. And where in our mean scenario, the probability weighted outcome is 2.2 degrees, which builds on a little bit from what the credible policy commitments are today. So we are sort of building in some dynamic further change in policy, but where we're making a pretty clear judgment that we don't think that it is likely that the world is going to align behind what is necessary to limit temperature increases to below 2 degrees, and certainly not 1.5 degrees. So similarly then, these scenarios, they can generate really interesting sort of profiles for future energy demand, right? So here I have oil demand, gas demand, coal demand. And again, so the really important takeaway here is that in our mean scenario, you end up with somewhere between, right, what happens if policy doesn't move much from here, and in between, say, the Paris-aligned sort of type of outcomes. But these are really big differences, right? So you think about, I'm going to use oil demand as an example, right? There's a very big difference between 70 million barrels per day of oil consumption in 2050 and 40 or 90, right? And so for oil intensive companies, either on the production side or the usage side, these differences are going to be very, very important. So again, if you don't capture the middle of this probability distribution, right, then you're probably going to generate ultimately income streams that aren't going to align very closely with what the future is probably going to look like. And the same is true for gas demand, the same is true for coal demand, and also for non-fossil fuel sort of power generation and electrical vehicle sales. So to be very clear, from where we stand today, we are projecting a fairly significant, or in fact, a very significant energy transition, right? So it's not like we think that the world is standing still. It's just that that energy transition is not going to be as fast and as complete as what you would get if you were doing this analysis focused on, say, the NGFS early action scenarios or below 2 degree scenarios. So this is going to be very, very important when it comes to the security analysis that I'm going to show in a minute. This also then here sort of shows the pathway for carbon prices. And again, it won't surprise anybody given what I've said. We get an intermediate pathway for carbon prices between the extremes that you commonly get in off-the-shelf analysis. So let's get to some of the key results. From a security perspective, probably the most important takeaway is that the financial consequences of the energy transition that we're expecting. But even if you focus on the tails, this is not mostly a macro index level phenomenon. So for example, in our mean scenario, we generate an impairment estimate of 2.2% relative to what's priced in today, right? It's not nothing, but 2.2% is very small relative to even the amount of variation you can get in a 3-month period in most sort of major equity indices, right? So that's a relatively small effect, and it reflects the fact that, you know, at a global level, at a global index level, equities are relatively well diversified, right? So you've got a lot of companies, and we're going to get into this in a minute, where you have large negative exposures offset by large positive exposures. And then as we drill down, what we're going to find is that the amount of dispersion just gets larger and larger. Okay, so now we're at the sector level for equities. Here you can see we've got larger effects. The most negatively impaired sector, unsurprisingly, given how fossil fuel intensive it is the global energy sector, and to a lesser extent, consumer cyclicals and non-energy materials. On the other hand, the utility sector is the big beneficiary of the energy transition on average. And the reason for that is not that we're assuming that they're not exposed to carbon prices. It's because the energy transition involves a very significant electrification of the global energy system. And by virtue of that, you get a lot of demand creation in the utility sector that many companies can benefit from, even those that can't necessarily pass on all the anticipated carbon prices onto end users. Right. Fixed income, generally the results are smaller, which I think is very intuitive. First of all, the duration of a corporate bond is shorter than the duration of an equity portfolio, right? Because a bond is issued for a finite period. Secondarily, corporate credit is further up the capital structure than equity. So generally, the corporate credit results are smaller, but sort of correlated with what we find for equities. And then this is the punchline, so to speak, right? So this is all of the companies in the MSCI Global Index split across the major sector breakdowns and sort of showing the fair valuation sort of estimate according to our analysis. Right, so what you can really see is the dispersion. I think that's what should come through very clearly. The mean effects tell you relatively little about what any individual company's exposure is likely to be. under our mean scenario, and you would get sort of similar results, right? You might say, look, Jeremy, that's a really interesting work you've done about the future of climate policy, but I don't buy it. I've got a completely different view. Well, you can use our analysis, change the probability contributions, do whatever you like with it to generate a different mean outcome, but you'll still be left with the overall conclusion: the climate risk and opportunity is primarily an individual, it's primarily a micro phenomenon from an investment perspective rather than a macro phenomenon, right? So you take the utility sector, large overall aggregate beneficiary, but with very big positive impacts for some firms and very large negative impacts for others. And so if you're making investment decisions, it's very important to take this into account. Now, I know that we're starting to run out of time, and so I'm going to end with a final point. So I'm probably not going to get to all of my slides here. Actually, I'm nearly close to the end, so that's good. There are caveats around all this analysis. Even though we think that this work is edging us a little bit closer to, I'm going to use the term truth inverted with quotation marks, because there is no actual truth in modeling, but it gives us I think a better representation of what the future might look like. Clearly, there are a lot of things that this type of work can't take into account. These are long-run equilibria. So they don't take into account short-run dynamics. They don't kind of take into account non-linearities in the financial system. Future technologies that aren't already in some way at scale today are difficult to build into integrated assessment models. And although we've tried to be forward-looking in our policy assessments, individual corporate business strategies are effectively treated as passive in this analysis, right? So the company reacts, doesn't sort of understand how it might be negatively affected, and then change its business strategy as a result. Now, early next year, we're going to be publishing some work that sort of shows how dynamic business strategies, so corporate transition strategies, if they're credible, can be incorporated into this analysis, and that will change the results again, because one company that's moving more progressively than we're currently building in, that means less market share for another. But with that, I'll end the presentation. I hope that was sort of useful, and look forward to the Q&A afterwards.
Thank you very much, Jeremy. Wow, that's impressive. So let us keep the discussion and the Q&A for the Q&A session. Let me already thank Francesca and Nico for their question, but I put that in the fridge because we first need to hear about Sébastien Pouget presentation. Sébastien, the floor is yours. You have 25 minutes.
Thank you very much,
Christian.
Yeah. Thank you very much, Christian. Thank you all for being here. Thanks, Jeremy and Stephanie, for the great presentation. And I would like to thank Dirk and Christian for including my contributions to this session. So yeah, I'm going to talk about shareholder engagement on climate change issues, and I'm going to present you with a conceptual analysis and then a few empirical facts that I gathered with my co-authors. Yeah, so climate change is one of the most dramatic corporate externality that our economies are facing. It has been very well described in Jeremy and Stephanie's presentation, and it is today this externality is clearly not internalized in the economic system, as Jeremy again and Stephanie has shown. The policies of the different countries are not really aligned with the net zero objective that the various societies across the world have given themselves. So this generates a big externality in the sense that corporations, when they set up their strategies, are not going to fully account for the societal impacts, in particular their impacts on climate change, when they make their decisions. And we know that big strategic issues are decided in general after shareholder insights have been offered during the general assemblies. And we know that in current financial markets, we have a variety of investors with different views about what should be done by firms in terms of their level of responsibility or sustainability, if you will. So we have responsible investors on one side that will take into account environmental and social issues in their investment decisions. But we have more traditional investors who maybe doubt the fact that policies is going to be put in place, climate change policies are going to be put in place, or maybe they think that it's not going to be material for business. And so these different views between different investors is actually creating a conflict of interest between shareholders and about what should be the strategy of the firms. And Jeremy, in his one of his last slides, actually highlighted the fact that there is a lot of heterogeneity in terms of micro performance, depending on the type of strategy that a firm is following. And so, in this context, what I'm going to talk about is two related streams of work. First, conceptual analysis that is going to try to understand how the conflict of interest between shareholders is going to play out in the governance of the firms, and what type of shareholder is going to be able to impose, in a sense, its strategic orientation. And then in a second time, I will discuss about what happens actually in shareholder meetings in corporations across the world, and to try to understand better the motivations for investors to promote or not climate change policies at the firm level. So this theoretical work I'm going to present first is joint work with Christian. So all the difficult questions will be for him during the discussion. And so it's taken out of a paper that is entitled "Investment Strategies in Corporate Behavior with Socially Responsible Investors." So our goal in this paper is to set up an asset pricing model that we augment by taking into account the fact that the strategy of the firm that the firm can choose can have an externality and is not exogenous, that it depends on the votes of shareholders. And so we are going to try to propose a CAPM model, if you will, in which we endogenize the strategic decision of the firms. And we are going to show that it has various implications, both for the fact that the sustainable strategy might be chosen even if the responsible investors are not a majority of the investors on the market. And we are going to also show that this endogeneity of the voting strategy is going to generate multiple equilibria in terms of strategic choice. So there is going to be a little bit quick in the interest of time, but there is a very interesting and wide literature on both asset pricing models with externalities, and there is also a growing literature on voting in firms. But we think that our model can highlight a phenomenon that has not been yet studied before. So if the slides, I can give you the slides if you're interested in looking at this literature. So let me explain how we proceed in terms of conceptual analysis to study the link between investments by shareholders, their voting policies, and then the asset pricing on financial markets. So we are going to have a very stylized analysis in which we consider that there are 3 dates. At the first date, there will be a financial markets. The second date, a shareholder meeting is going to be organized and voting will occur. And then in the long term, date 3 might be in the long run, a firm is going to generate some results. So let me explain you these different steps one by one, going backward. At date 3, so in the long run, the firm is going to generate results, both economic and societal results. And these results will depend, these outcomes will depend on the strategy chosen by the firm. If the firm chooses the standard strategy, then it's going to generate a return expected return that we call R, and particular volatility of its cash flow. And we assume that it has no externality on society. And if the firm instead is implementing a responsible strategy, for example, sound climate policy, for example, based on internal carbon pricing or other types of tools that corporates have in order to implement a climate policy, then we assume that its cost will be increased. So its financial cost of operations will be increased by C. So the overall financial return of the firm will be R minus C. And so this is to reflect the fact that it's actually costly to develop a climate policy. You have to refrain maybe to pollute, to install new technologies that avoid emissions, or you have to refuse to serve some clients in order to lower your level of operations. So this is reflected in the term C. So that's the financial return. But we assume that if the responsible strategy is chosen, then there is a positive externality that is generated.
And we lost Sébastien, I think. Let us wait a minute for him to come back.
Yes. Can you hear me? Let me stop my video and...
I can hear.
Yeah, I can hear you.
Okay. Did you have a cut in my talk, or?
No, not on my side.
No, so I think we lost Christian then, in fact, right?
I think so, yeah.
Okay.
Yes.
So sorry. So let's let me continue, and then Christian knows very well this analysis, so he's not going to be lost when he comes back. Yeah. So we consider that if the firm chooses the responsible strategy, then it creates a positive externality in the sense that it mitigates the climate change issue for society. And so we model this climate change mitigation externality creation, positive externality creation by this value E. Okay. Are you back, Christian? I think you were.
Yes, I'm sorry. I believe it was a problem on your side. It was a problem on my side.
Yeah,
sorry
it's a difference of views. Yeah, exactly. So this is what happens at day 3, and then what strategy the firm is going to develop depends on what shareholders have decided collectively. And this we model at day 2 this shareholder decision via a shareholder meeting, and we consider that during this meeting the shareholders have to choose between 2 strategies, the standard and the responsible one. The vote is going is modeled as a very simple majority vote with a 1 share 1 vote system. And the vote itself is going to depend on what are the holdings of the various investors in this firm, and the holdings will be set up in the financial markets. We consider that at this date 1, in which holdings are materialized, an initial owner is going to sell his shares to the public investors. So for example, you can imagine that this is an IPO. And there will be 2 types of investors who will be willing to buy the shares of this firm. There are socially responsible investors, and we assume that they are valuing both the financial returns, but also the externalities. So they are willing to, in a sense, sacrifice some profits in order to promote this climate change mitigation policy. And we assume that they are in proportion by. And then there are other type of investors who can also buy the shares, are traditional investors. They only value the financial payoffs, so the returns and the cost of this responsible strategy. And so they are going to interact on the financial market, and they are going to trade at price P. And so what we are going to do in this very stylized model is that we are going to try to understand whether the firm is going to be responsible or not, will be choosing the responsible strategy or not. And so to do so, we are going to use what is called rational expectation logic. And we have to use such a logic because the corporate strategy is endogenous and depends on what happens on the financial market. But what happens on the financial market depends itself on what the investors expect will happen to the corporate strategy. And so in particular, you see that corporate strategy is going to affect what corporate strategy, is expected will affect what is the demand of investors. And the demand of investors is going to affect share prices, which are going to affect investor holdings, and the holdings are going to affect the votes of the shareholders. and which is going to which are going to affect the choice of strategy itself. So there is a loop here, and we close this loop via this rational expectation logic. So how does it work? We are first going to consider that investors believe that the firm is not going to develop a very ambitious climate change policy. In this case, the firm chooses a standard strategy. If the firm chooses a standard strategy, then there is no particular societal impact, there is not this positive externality that I've mentioned before. And so all investors' demand will be similar. And so the price will, in particular, the demands will not reflect this externality that will not be generated by the firm, this positive externality. And so the share prices are not going to reflect this externality either. All investors that we assume are individually identical will have identical holdings. And because all investors have identical holdings, then this strategy, the standard strategy, will be chosen by the shareholders during the vote only if responsible investors are less than 50% of the market, meaning that they don't have a majority. We assume that responsible investors vote in favor of the climate change policy, and whereas traditional investors vote in favor of the standard strategy. So in this case, so you see that the condition for the firm to remain brown, in a sense, is that the responsible investors are less than 50%, constitute less than 50% of the market. And so that's one possibility, one equilibrium. Then there is another equilibrium in which shareholders or investors can expect that the firm is going to develop this responsible strategy. In this case, various investors will have different demands. Traditional investors will have a demand that takes into account the cost of implementing the climate change policy, but responsible investors will also take into account this cost, but they also will recognize that there is a positive societal impact for this climate change policy. And so their demand for shares will be stronger in this case than the demand from traditional investors. And so these demands are going to both be reflected into the price, and in particular, a proportion pi of the externality is going to be reflected into the share price, because the proportion pi of investors are actually taking into account the externality when they set up their strategy. And so that's already what you see here is one of the first main results of our analysis with Christian, which is that when a firm is going to implement an ambitious climate change policy, even if it's costly from a purely economic point of view to do so, it might be still the case that the stock price positively reacts to this announcement, and so generates an alpha if the proportion of responsible investors and the positive externality created by the firm in this case are large enough. That is, if pi E minus C is positive. So this is the share price that is going to occur at equilibrium on the market. This will lead to investors holding, and in particular responsible investors, because they, at any potential price, they'll demand more shares than traditional investors. They demand more shares of this to be green company. They will hold more share per investor. And because they hold more share per investor, the responsible strategy is going to be chosen if the proportion of investor, of green investor, of responsible investor, is larger than a threshold. And this threshold, what is interesting is that this threshold is lower than 1/2, meaning that even if the responsible investors are less numerous on the market than traditional investors, they could still have a majority during a one share, one vote meeting, because per investor, they hold more shares of the firm. And this leads to the firm to choose this responsible or climate change mitigation policy. And so this is this condition that you have on pi is the condition for this equilibrium strategy to be chosen. And so this leads to our second main result, which is that even if responsible investors on the markets are less than are not the majority of the investors, they are not the majority of assets under management, if you will, they can still have a majority on the given company because they per individual, per investor, they will invest more in a firm and get more power during the General Assembly meeting. So that's the second main result of our analysis. And the third important result of our analysis is that because this threshold here for the existence of this responsible strategy, the threshold on the proportion of responsible investor is lower than 1/2. We have that there is actually a region, a proportion of responsible investor, which is such that the two equilibria coexist, meaning that depending on the expectations of the investors that the firm is going to develop a green or a brown strategy, depending on this expectation, the expectation will be auto-realizing, if you want. And so because of that, there will be multiple equilibria, which means that the level of engagement of a company towards climate change can be fragile in this region. So it will all depend on the expectations of investors that can, and if they shift this expectation, then it will shift the support of investors towards the climate mitigation policy. So that's what I wanted to say regarding this theoretical analysis. And I know that I don't have a lot of time, so I'm not going to discuss about this extension of this simple analysis to the case of multiple firms or to different types of voting mechanisms. I just wanted to say a few words in the few minutes that I have left about what happens in practice regarding voting at shareholder meetings by asset management firms. And so this is a joint work with Marie Brière from Amundi and Dauphine University and Loredana Uresh-Rango. What we try to do in this empirical paper is to try to see whether in practice, indeed, we can identify various types of investors with various types of voting policies. And so we are going to study how asset management companies vote on climate change issues during shareholder meetings. And one of the externality that we consider is climate change. And so if we observe that there is a variety of voting policies, we are going to try to understand why these voting policies are different. In theory, there are various reasons why investors might vote differently. If you have in mind the narrowly defined shareholder value, if climate change policies are costly for the firm, and in general, a lot of firms consider that they are costly because their managers are actually opposing these policies. So if climate change policies are let's say damageable for the future profitability of the firm, then narrow shareholder value would predict that you should not that you will not support the shareholder the climate change mitigation policies, let's say. On the other hand, there are at least two reasons why you might want to support such climate mitigation policies. The first one that we modeled in the paper with Christian is delegated philanthropy, the fact that maybe you are engaged, you have a pro-social attitude, and you want to be, you are ready to sacrifice some of your return in exchange of the firm in which you invest to generate a positive externality. This is what is referred to as delegated philanthropy in the Benabutirol world. And there is another reason, which is the shareholder value related reason that is called universal ownership, that has been studied in particular by Monks and Minot, that tells you that if you are an investor and you are holding a large portfolio for a long time, if you are what is called a universal owner, then it might be the case that an externality that is generated by one firm negative externality due to, for example, climate change impacts related, for example, to, let's say, a temperature increase that is actually detrimental for your activity. This externality for one firm can actually be detrimental for the activity of another firm in the economy. And if you're a universal investor, a universal owner, and you are holding both firms in your portfolio, then you might want firms to actually fight against climate change in order for climate change not to be detrimental for the overall value of your portfolio. So this is a shareholder value viewed with a more global understanding. And so what we are going to do in this empirical paper that we have built with Marie and Loredana is to see whether the universal logic was actually, we could find traces of this universal logic or the delegated philanthropy logic in the data. So I'm not going to be very, just in the interest of time, I'm going to skip again the literature, but there is a very interesting literature that is also related to this issue of voting on environmental and social issues in general assemblies. I'm not just going to give you a very brief outlook of the data that we are using. We are using data from 2013 up to 2016. We are currently trying to update this data to more recent periods. We are looking at all the US fund families. So there were 213 fund families that we were able to study, to get data about. And we are studying fund families because it's most of the wide majority of fund families are using a centralized voting policy. And we were able to identify 13,108 different shareholder resolutions on environmental, social, or governance issues at more than 2,000 companies worldwide. And so what we are interested in is for each fund family to look at what is the proportion of vote in favor of the shareholder proposals, and in particular on climate change. And so we study climate change. We also study human rights issue, discrimination, compensation restrictions. And so we are interested in understanding whether different fund families vote differently and whether we can try to explain their votes based on the universal ownership logic or based on the delegated philanthropy logic. So how do we define universal owner? We define a universal owner for a fund family that holds more than 2,000 stocks, different stocks, and that has a turnover of less than 35% per year. Okay, so it means that it's fund families that hold a wide variety of stocks and for a very long time. And to give you, so the universal owners in our data that we're able to identify are BlackRock, Schwab, DFA, State Street, Northern Trust, and Vanguard. These are very, very important investors. And so the results in a nutshell are summarized in this picture. What you have in this picture on the horizontal axis, you have the number of stocks in the portfolio on this left-hand side, the number of stocks in the portfolio, and then in here on the vertical axis, you have the support for environmental and social resolutions, and you have here how the different level of support for the different fund families in blue. And in red, what you see are the proportion of support of the universal owners. And what you can see is that the universal owners have a proportion of support controlling for the number of stock that is pretty low, in fact. And you can also see that if you look at the turnover on the right-hand side, here you have on the horizontal axis, you have the turnover. And you have the proportion of support on the vertical axis. And again, in red, you have the universal owners. And so what you see is that universal owners controlling for turnover, they still appear to support pretty mildly the environmental and social resolutions. And so this shows you that universal ownership does not seems to be a very strong motivation for voting in favor of environmental and social resolutions. And this result is valid also if we look at climate resolution, in particular, if we focus on climate resolution. On the other hand, what we find is that the fund families with a larger proportion of socially responsible funds within the fund family, these fund families with a larger proportion of socially responsible investment funds do tend to support more climate change resolutions and other environmental and social resolutions than other mutual funds families. So what we conclude from this is that it seems that the delegated philanthropy motivation is stronger than the universal ownership motivation for favoring climate mitigation policies. And our results are robust if we look at only the big three and not other universal owners. And they are also in particular valid if we look at climate change reporting resolutions, meaning that shareholder resolutions that just request the firms to report on climate change, on their CO2 emissions, for example. And we see that our results are still valid, which means that it's not our results are not hindered by the behind the door engagement process, because actually reporting climate change would be a prerequisite even to do behind the door engagements. So I'm going to stop this to stop there, and I'm looking forward for the discussion. Thank you very much for your attention.
Thank you, Sébastien. Thank you, Jeremy and Stéphanie.